So in this video, I'm going to talk to you about volatility. Now that sounds really boring. You're thinking, what relevance does this have to any of my Betfair trading? Well, it's got the most critical relevance to your Betfair trading. And also I'm going to tell you something in this video that probably you've never heard mentioned before. You probably haven't seen it in a book or video because a lot of people don't truly understand volatility properly or how it influences your trading. So if you're interested in learning about that, then just watch the rest of this video. If you're interested in learning to use BetAngel, head on over to our website where you can download a free trial. If you're interested in learning how to use it, then head over to the BetAngel Academy where you can do exactly that. And if you want to talk to like-minded people, then head on over to our forum. So let's first understand what volatility is. And in simple terms, this is the range of movement that we see within any particular market. Now you have to have a time frame to that because fundamentally speaking, you need to understand over what period you're actively trading and therefore you'd measure volatility over that period. And we're lucky in sports events that that can be accurately framed. In the case of a horse race, we have a definitive start time. In the case of a football match, we have 90 minutes. And in the case of a tennis match, it's a little bit more ambiguous because the end time is sort of not defined, but the number of points are, and therefore that moves around a bit. But fundamentally speaking, in each market, you can actually judge volatility. And the way that we would do that is we'd basically take the lowest odds that have been traded within a market and the highest odds that have been traded within a market. That defines for us what we call the traded range. So whenever I look at a graph, I will basically have a look at that traded range to understand how volatile the market is. And if I draw a line at the bottom and draw a line at the top and then do a big line in between, what we're looking at there, the total traded range, or looking at how volatile that particular market is. And what you will find is different markets exhibit different types of volatility. So volatility is really important because it defines what you're actually going to be doing within the market. If we have a low volatility, we have a narrow traded range, then basically we would look to work with inside that particular traded range. However, if we have high volatility, then we would look to exploit that level of volatility that we see within the market in any number of ways. But one of the key factors that you're looking at when we have volatility within a market is it sort of not only shapes the potential upside, but it also shapes the potential downside. Because imagine we have a market that's working within a narrow traded range. If you traded that market at random, you'd be somewhere within that traded range at some point in time. And, if you had a terrible trade, you could be sort of laying at the top of the traded range. And therefore that is your maximum loss. However, if you have a good trade, you'll be laying at the bottom and that is your maximum profit. And there's no loss because you're at the bottom of the current traded range. So if you have a tight traded range, what you also have, you have limited sort of potential to profit, but you also have a limited potential to lose money as well. So the traded range is important in defining both sides of that. But let me reframe this for you for a second. If we have a traded range that looks like this and we trade it once, then we have a little bit of profit in the market. If we trade it twice, we have some more profit, 3 times, 4 times, and so on. So you can actually see that what you're doing when you're actively trading within the market is you're adding to your profit potential within that market. But if the traded range is defined clearly as this, then your loss is always going to be limited. So it actually improves your chance of actively trading. Now, of course, if we have a massive traded range, the issue that you have there is if you get in the market up here and it's going to move all the way down to here, then your loss is potentially massive. So from a trading perspective, you need to get the balance of all of those right. The way that you make money trading in the long term is you need to understand how much you win when you win, how much you lose when you lose, how frequently you win and how frequently you lose. And it's a mixture of all of those variables that actually allow you to understand how you're going to be profitable in the long term. And if you actively monitor those things, that will allow you to understand how you need to influence what you're doing at the moment in order to turn whatever strategy you're pursuing into a profitable one. Now, to explain this in depth requires a whole video, which is lucky because I have actually done a video to explain this in great detail. But understanding that traded range will tell you what your maximum profit is, but what your maximum loss is. But the interesting thing is while you're framing your maximum loss within a market, you can actually increase the amount of profit by trading it more than once. And that's one of the things that makes us really interested in volatility. But of course, that relies upon us being able to predict what that traded range is. So let me ask you this question. What do you think are the most and least volatile markets. So every single market that I've traded, which is hundreds of thousands now, I'm looking at how volatile the market is, and I'll gather data on many markets as I possibly can, even ones that I don't trade, in order to get that number, to truly understand exactly what's going on. And probably a good example I can give for you for that is tennis, because we can actually frame quite neatly in a tennis match how volatile a market is likely to be and which are the most volatile markets. And there are actually two answers. There's the mathematical one, and then there's the sporting one, because they both have a role to play whenever you're actively trading. So in a tennis match, you're always going to have the favourite go off odds on because there are only two players. So one of them will be slightly odds on, one will be slightly odds against. So what do you think is going to be the most volatile, the match that has the widest range of movement? A favourite that's at 1.2, a favourite that's at 1.5, or maybe the match is dead level and they're both priced at odds of 2. They're both evens. They have an equal chance of winning the match. Well, have a think about that, but let's think about a coin toss. Typically a coin toss is something that's used to describe how sort of random something is. If we toss a coin, foregoing all the complexity, it could end up heads or tails, and that's considered pretty random. So when we look at an individual sport, when you actually see the odds heading towards that magical level of 2, that's the moment at which the market is least uncertain. So when we look specifically at tennis, what you will actually find is as the market approaches odds of 2, it's approaching that 50-50 chance of either player winning the match, a bit of a coin toss. And as a consequence, those are the matches which tend to exhibit the largest swings in odds as the match progresses. So when you get players that are starting near odds of 2, then that is the markets that have the biggest range of volatility, the biggest potential for gain, but if you get it wrong, the biggest potential for loss as well. However, that's only one part of the equation, because especially as we're dealing with sports, we shouldn't just look at the mathematical side of things. If we actually look at the sport on an individual level, then we could look at the men's game and the women's game, and you can immediately see a difference between the two, because in Grand Slam tournaments, men have to win the best of 5, but women only have to win the best of 3. So a break of serve in a women's game is much more significant than in a men's game. So therefore, the women's tennis is much more volatile than the men's tennis. You get bigger swings because just a simple break of serve or a mistake, an error, or an injury can swing the odds dramatically back in the other direction. So we have two answers to how volatile is tennis and what would the average traded range be. But typically the most volatile tennis match that you'll get will be a women's game where both of them are fairly evenly matched. And then of course we can throw in surface types as well. So if we look at clay is a surface that sort of is much harder to win on service, and therefore you tend to get more breaks of serve. So you can sort of almost have 3 different answers to the same thing there, but it allows you to home in on a prime opportunity or necessarily avoid ones that don't look as good. But my question to you is, do we see the same thing in a sport like horse racing? So when we look at horse racing, you could look at those odds of 2 and say, well, that's 50-50. But what we're saying here is it's 50% chance of the favourite winning, 50% chance of something else winning. So if we look at something at odds of 2, is that going to be the most volatile? Now I could rattle on and give you all sorts of spreadsheets and wonderful graphs, but I'm going to give you a straight answer here. Yes, it is. If you see something at odds of 2, then necessarily that represents more or less the middle of the bell curve in terms of volatility on horse racing. So what I mean by that is if we look at a bell curve, the peak of that bell curve is going to be where you see the most volatility, and in horse racing and in all sports, it more or less is odds of 2. As we begin to spread out on that bell curve on either side, then the market generally becomes less and less volatile. So what this means for you in terms of horse racing is if you see something priced at 1.5, then it's most likely that will be much less volatile than something priced at evens where there's greater levels of uncertainty. However, as we start to move up at bigger odds on the other side, say we have something priced at 6, then that becomes less volatile again because there's more certainty that it won't win. I hope that sort of makes sense to you. But basically the center of the market is odds of 2. Now, of course, there are other factors to take account of in horse racing. So, for example, if we're looking at a maiden race, then necessarily that will be a race where perhaps the horses have never run before. So that throws in a whole new element of volatility into the market. And if we're looking at a competitive handicap at larger odds, then necessarily we're sort of saying, well, that's going to be less volatile. It's going to have a smaller traded range. And there's going to be more certainty in the market if it's a competitive high-grade handicap. The horses are going to be well known, they've got form lines, and therefore the market will be a little bit firmer. It will have a narrower traded range. So yeah, you can actually look at a lot of different sports, and you're looking for a large traded range, you're looking for biggest opportunities where odds are going to swing around all over the place, then you're looking for something that is a 50-50 chance in effect. It all sort of makes perfect sense when you look at it from that perspective. However, there is one other thing that you need to be aware of that may influence exactly how you take advantage of this opportunity. So there's a really curious thing about betting exchanges when we're talking about volatility, and that is that the volatility on a ladder doesn't quite fit what we see within the market, and you don't see people talking about this very often. And if we look at odds of 2, that's the midpoint in terms of probability. That's got an equal chance on either side. But when we look at the ladder, they go in increments from 101 all the way up to 1000. And if we look at odds of 2, there are 100 ticks between 2 and 101, but there are many more above it. And as a consequence, the market is slightly distorted from that particular perspective. You tend to see things drifting slightly more than you see prices coming in, because it takes a lot more backing and a lot more effort to push something down the ladder than it does for the price to head up in the other direction. So yeah, that's a curiosity of the way that the exchange is built. And all of those mathematics are still in place, but the way that you see that manifest itself on the ladder is slightly different. So understanding how volatile a market is will allow you to understand what the average traded range is. And that's important because, say we were pursuing a strategy like scalping, we're only ever going for a 1-tick gain when we're scalping. So we want the smallest possible loss. If we're trading in a market with a narrow traded range, then we'll get a 1-tick profit perhaps more than once. But when we lose, we're not going to lose too much because that traded range sort of frames that loss for us. Now, if you want to test my theory, go off now and trade a horse race where the favourite is odds of 2, and preferably it's a novice or a maiden with unraced horses in it, or horses that have not raced for a long period of time. Try scalping that and see what happens. Yes, you'll get loads of positive scalps within that particular market, but because the average traded range is so large, when you get a loss, it's going to be absolutely huge. So you've got this massive traded range. You're gaining this much within that traded range, but your potential loss is this much. It's huge. It's not going to work. And that's why you need to understand how volatile a market is likely to be. But also you can understand from this video, hopefully, that when we're looking at tennis, you can see that there's more uncertainty in a tennis match as it approaches odds of 2. But also when we look at the market in general, there are other factors that take place that can influence exactly how that all plays out. Surface types and so on, or if we're looking at horse racing, different race types will also have a hand in exactly how the market behaves. So yeah, that's why you need to understand volatility, because it teaches about the traded range, and that's a key and important aspect when you're actively Betfair trading.